You can win 70% of your trades and still lose money. Not occasionally, not through bad luck. Consistently on a strategy that looks brilliant on paper. Before we go further, this is educational commentary, not personalized financial advice. What I'm about to show you is one piece of math that quietly bankrupts premium sellers, and almost nobody runs it before they place the trade. It isn't complicated. It's just uncomfortable. By the end, you'll never look at a win rate the same way again. Here's why this matters right now. Selling premium is the most popular trade on retail platforms. Credit spreads, iron condors, cash-secured puts, zero-day options on SPY and QQQ. The pitch is seductive. You collect money up front, and most of the time the trade expires worthless in your favor. High win rate, steady income, feels like a paycheck. Screenshots of 80 and 90% win rates flood every trading feed. And that number is exactly what fools you into a strategy with a negative edge. Let's make it concrete with one trade. You sell a put credit spread on SPY. The spread is $100 wide. You collect $30 in premium. If SPY stays above your strike, you keep the 30. If it drops through, you lose the width minus your credit, so $70. That's the whole trade. You risk 70 to make 30. Now here's the part everyone skips, what actually happens over many trades. Say you're good, you win 70% of the time. Out of 10 trades, you win 7 and lose 3. 7 wins at $30 is $210. 3 losses at $70 is $210. Add it up. 0. You were right 70% of the time and made nothing. Now add commissions, slippage, and the occasional gap that blows past your spread. That flat line becomes a slow bleed. A 70% win rate broke exactly even before costs. So name the misconception, because it's the thing costing people money. Traders believe win rate is edge. It feels like edge. Winning most of the time triggers every instinct that says you're doing something right. But a win rate is just how often you're right. It says nothing about how much you win versus how much you lose. And in premium selling, that ratio is deliberately stacked against you. You collect small, frequent wins and pay them all back in rare, large losses. Here's the sentence to keep. You are paid by expected value, not by being right. Expected value is win rate times average win minus loss rate times average loss. Being right often only helps if your wins are big enough or your losses small enough to make that number positive. A high win rate with a lopsided payoff is a mirror. It reflects your confidence back at you while your account quietly does the opposite. Now, why is the payoff stacked this way? Because the options market isn't stupid and it isn't handing out free money. The price of that spread is set by everyone's collective estimate of risk. When you sell premium, you're being paid to take on tail risk, the risk of a sharp move against you. The market prices that risk with something called skew, and put options carry extra premium precisely because crashes happen faster than rallies. You're not collecting income, you're selling insurance. Think about what an insurance company actually does. It collects small premiums from thousands of people every month and wins almost every time. High win rate. Then a hurricane hits and it pays out enormous claims all at once. The entire business survives on one thing, pricing those premiums so the rare disaster doesn't wipe out years of collected cash. That is your job as a premium seller. Most retail traders collect the premiums and completely ignore the hurricane math. And the hurricane is not hypothetical. Look at what one bad session does to that ledger. Imagine you strung together 20 winning trades, $600 of premium, feeling untouchable. Then a gap-down morning takes SPY straight through 3 of your spreads at once. 3 losses at 70 plus the ones that gap past your defined risk, and half a quarter of steady income vanishes before your coffee's cold. The wins arrive in a trickle. The losses arrive in a flood. This is why the honest metric isn't win rate, it's expectancy per trade. Take your average win times how often you win, subtract your average loss times how often you lose. If that number isn't clearly positive after fees and slippage, you don't have a strategy, you have a countdown. On our example, 30 times 0.7 minus 70 times 0.3 equals 0. You need either a higher win rate than 70%, a smaller loss, or a bigger credit to have any edge at all. So what does a disciplined trader actually do differently? First, they compute expectancy before the trade, not after. They know their real average loss, including the day's price blows through the short strike. Second, they size so that a cluster of losses, 5 or 6 in a row, which will happen, doesn't dent the account. That usually means risking well under 1 or 2% of capital per position. Third, they widen credits or tighten strikes until the payoff math turns positive, and if it won't, they pass. And they treat correlated positions as one bet. 10 credit spreads on SPY, QQQ, and tech names aren't 10 trades. On a red day, they all lose together. That's a single oversized position wearing a diversification costume. Sizing for the true, combined tail is the difference between a bad week and a blown account. The goal isn't to win more often. It's to make sure the times you're wrong don't cost more than the times you're right earn you. Here's where this transfers. It's not just premium selling. Any strategy that wins small and often while risking large and rarely, mean reversion, martingale averaging down, picking up pennies in front of anything, hides the same asymmetry. Next time someone shows you a win rate, ask the only question that matters. What's the average win versus the average loss? If they can't answer, they don't know their edge, and neither do you. If this reframed how you read a track record, subscribe. We do signal, not hype. Now go check your own expectancy before your next trade.